Hi everyone, today we are going to discuss inflation. What is inflation? What is the reason? And what are the measures normally taken by Reserve Bank of India or central bank in any country to control the inflation? What are the effects of inflation in an economy? So generally this video is meant for those who trade in share market. They always hear this news that inflation rate, CPI, consumer price index, and US Federal Reserve increasing and decreasing interest rates. So what is going to happen in the market and how this is going to affect our economy and in stock market. Stock market is always the pulse of the economy. Any change in an economy is seen in stock market. If there is a positive change, that can also be seen in stock market. If there is any negativity, immediately you feel it in the stock market first. So let's start. What is inflation and what are the other control system or the tools that RBI is using to control the inflation? You must have heard repo rate, reverse repo rate, cash reserve ratio, that means CRR and SLR, statutory liquidity ratio. There are many, so we'll just go one by one and see. First, let's see what is inflation, and then we will discuss what is RBI's role in controlling inflation. RBI means that is India's case, but other countries there is a central bank. They control the economy there. And what is repo rate, and what is reverse repo rate, and what is CRR, and what is SLR. So what is inflation? Inflation, this is the definition. There are many definitions. So this is, I think, a simple one that everybody can understand. Inflation is the rate of increase in prices over a given period of time. It is the overall increase in prices over the increase in the cost of living in a country. Inflation measures how much more expensive a set of goods and services has become over a certain period. So what is the meaning of this? Inflation is the rate of increase in prices over a given period of time. So it means when there is inflation, you feel it where? You feel it in the market, whether it is in vegetable market or grocery market or anywhere. You will feel a price increase. Everything is getting expensive there. So we measure it, we take a period of time and measure what is the rate of increase of this price change or the service rate, whatever it is. So that is what is written here. Inflation is the rate of increase in prices over a given period of time. Normally RBI is evaluating every 2 months inflation data. And it is the overall increase in prices or the increase in the cost of living. So when prices go up, means your cost of living is also getting increased. You have to spend more money to live. You need to spend more money to purchase your food, your daily essentials, everything. And inflation measures how much more expensive a set of goods. So it means what is the rate of increase. This is what we measure. Every year there is inflation. You know that if you spend 1 lakh rupees or 100,000 rupees this year for buying your essentials, next year you will have to pay minimum 7% or 6% extra because the prices will go up. This is we call as inflation rate. When you save money, and this is the reason why when you deposit money in bank, as fixed deposits, you get interest on it, because if you deposit 100,000 this month, next year same month when you should not get only 100,000, you should get additional. This is calculation of inflation there, because the value is getting depreciated. So this is what is inflation. When inflation comes, the prices will go up, cost of living will be increased. And what is the reason for this? There are many reasons. If we take India's case, if oil price, we are buying oil from Gulf, and now Russia and other countries. So if the prices of oil is going up, then definitely our food prices will also automatically, going up with the same, because the distribution of food, all over the country, oil is playing a major role. If diesel prices go up, then the price of the food item is also increasing. Now, what is the role of Reserve Bank in controlling inflation? What RBI does? RBI conducts monetary policy committee meetings every 2 months to evaluate inflation by monitoring various financial indicators such as CPI, Consumer Price Index, CFPI, Consumer Food Price Index for rural and urban, and final combined CPI data, Consumer Price Index data. Then RBI adjusts the interest rate, CRR, SLR, etc. accordingly to control inflation and liquidity in our economy. So you can see this news in newspaper, or if you are watching market, then you might have noticed that unless say that today RBI is meeting, so see their MPC meeting is today, so we are expecting same rate, or they are going to increase the rate of interest, or they are going to decrease the rate of interest, because this decision is playing major role in economies or markets performance. So these are the measures RBI is using. RBI is completely in charge of controlling inflation, so they can increase repo rate, they can increase reverse repo rate, they can increase CRR rates, they can increase SLR rate. So there are different methods they are using to control inflation, and it is decided or managed by Reserve Bank of India or Central Bank. So one of the measures that they use is repo rate. So let's see what is repo rate, and also reverse repo rate. Repo rate is the rate at which the commercial banks take or borrow money from the RBI. So what is repo rate? Repo rate is the rate at which the commercial banks take or borrow money from the RBI. Like SBI or Federal Bank or any other bank, commercial banks in our country, when they take or they borrow money from the RBI, like we are taking loan from the banks are taking money from RBI, Reserve Bank, they have to pay interest. That rate is called repo rate. So if RBI increases this repo rate, means the banks will have to apply the same rate of increase to the loans that they have already given to their customers. Otherwise, bank will pay from their pocket. So Reserve Bank, what they do when they have to control inflation, they increase the repo rate. So they will charge more interest from the banks. So what automatically banks will do? Banks will increase their interest rates. So if you have a loan, housing loan or personal loan or vehicle loan from any bank, SBI or Bank of India, Federal Bank or HDFC, once a central bank, Reserve Bank increases the repo rate, banks automatically increases they apply the same rate. If 0.25% increase done by Reserve Bank, then the banks will increase you. If suppose you are taking at 9%, then your rate of interest for your loan will be 9.25% with immediate effect when RBI applies the rule. So you'll have to pay from next month more interest. So this is called repo rate. So what is reverse repo rate? Reverse repo rate is the rate at which the central bank borrows money from commercial banks within the country. Similarly, the banks are taking or borrowing money from RBI. RBI is also taking money from commercial banks. So for this, they are paying interest. Like you deposit your money with any commercial bank, and you get an interest on it. Let's say you are depositing 10 lakh rupees fixed deposit, you are getting interest every month, 7%. Immediately the bank is informing you that from next month our rate of interest will be 10% per annum. So it means what you will do, if you have cash at home, you will deposit the same as fixed deposit or whatever it is at the bank, and you will get more interest. So why you have to keep money with you? Similarly, when RBI increasing their rate, banks will deposit more money. They will park more money with Reserve Bank, our central bank. So they will get more interest. So this is called reverse repo rate. So what is the effect of this increasing or decreasing repo rate or reverse repo rate? When RBI increases repo rate, they are charging more interest from the banks. So the banks will increase their loan interest rate. So customers will pay more interest to the banks, or they'll have to pay more interest on their loan that they have taken from the banks. But when it comes to reverse repo rate, what is the difference? Reverse repo rate, the RBI is offering attractive interest rate, so the banks will deposit more money with RBI or central bank, and they will enjoy the incentive, the benefits of high interest rate. So an increase in reverse repo rate means the commercial banks will get more incentives to park their funds with the RBI, thereby decreasing the supply of money in the market. So instead of lending money to the customers, banks will deposit money with RBI and enjoy high interest rate. This is what is reverse repo rate. So what is the effect of this? The banks is not giving loan to the customers, or they are reducing, they are controlling. So the supply of money in the market is getting decreased, less. This is what banks, a central bank is looking for. They have to reduce the supply of money when there is an inflation. Now the second is an increase in repo rate increases the rate of interest on all types of loans, such as personal loans, business loans, car loans, house loans, etc. So what happens? People will not take a lot of loans from the bank because the interest rate is very high. So the supply of money is getting decreased in an economy. So this way they control the inflation. Now what is CRR? Cash reserve ratio. During high inflation, the RBI or any central bank increases CRR rate to reduce the amount of money left with banks to sanction loans. It squeezes the money flow. It squeezes the money flow in an economy. So when they change the CRR rate, it means each bank has to keep minimum deposit of, let's say, 1 billion rupees with RBI. Now they take a decision that when there is an inflation, central bank says that no, next month onwards or from particular date, today onwards, your CRR is not 5%, 2%, 1%. Let's say, take an example with the value, for example, it is not 1 billion rupees, it is 1.1 billion rupees. So it means each bank has to transfer more money to central bank. So the money flow in an economy is getting reduced. Then what is SLR? Statutory liquidity ratio. Same like CRR, cash reserve ratio, banks are asked to have reserves of liquid assets, which includes cash, government securities and gold. And banks earn return on money parked as SLR. So here see, CRR banks, they don't get any benefit from Reserve Bank or Central Bank. It is just a mandatory or compulsory deposit. Banks will not get any interest on it or any incentive on it. But when it comes to SLR, statutory liquidity ratio, banks are asked to have reserves, liquid assets, which includes cash. They can give cash and government securities and gold as SLR. But here banks earn a return on money parked as SLR. So they get a return from central bank. Now here just showing the difference between cash reserve ratio CRR and statutory liquidity ratio. This is just for your information. So this inflation, general idea about inflation and what central banks they do and how they control inflation in an economy, I think it is clear with this small presentation. You don't have to go to all the details. It's economics and other terms, and how they calculate all this. These are complicated subjects. We don't have to know those details. We should have an idea about what is inflation, what central banks they do, and how this is going to affect our stock market. Simply when there is an increase in interest rate, normally stock market will go down. There will be a fall. Why? Because all the business units, they have to pay more interest to the banks, so it will affect their profitability. So if central banks increasing repo rate, then there will be a fall in the market because it is not good for the business units. But when they decrease the interest rate, what happens? It is going to support the companies, and they will have more money with them because they pay less interest, and they can have more loan from the bank at low interest rate. So there is more liquidity, there is more money in the market, and companies will plan expansion. So this is good for the stock market. So simply when Reserve banks increase the interest rate, it is not good for the market and it will affect the market's performance. But when they decrease the interest rate, it is good for the market. Why? Because it will help the companies to get more money from the banks as loan, and they can continue their expansion plans. They can recruit more employees, so and so. So these are the main points. So here you can just go through this file. It is simple. In case of SLR, banks are asked to have reserve liquid assets, which includes cash, government securities, and gold. And banks earn return on money part as SLR. SLR is used to control the bank's leverage for credit expansion. It ensures the solvency of banks. In the case of SLR, the securities are kept with the banks. See here, the gold or securities or cash, it is kept with the banks themselves, which they need to maintain in the form of liquid assets. Now, cash reserve ratio, CRR requires banks to have only cash reserves with RBI. It is only cash. CRR, and it means cash reserve ratio. It is not gold or securities. Banks don't earn any return on money parked as CRR. The central bank controls the liquidity in the banking system through CRR. Central banks are controlling the liquidity in the banking system through CRR. In CRR, the cash reserve is maintained by the banks with the Reserve Bank of India. Hope it is clear. If you have any doubt, put it in the comment box. Let's see how we can solve such any issues you may have faced in our next video. So that's it. Thank you for watching. Wishing you all success.